Nothing in this program should be considered investment advice. It is for educational purposes only. Please hit pause and read this disclaimer in full.
When everybody believes that nothing can possibly go wrong, that's the time to peel back and be a little bit more conservative. Am I saying sell everything right now? No. But is there anything wrong and foolish about sweeping off the top to build your resiliency in case it's not different this time? No, that's just wise.
Hello, everyone, and welcome to this episode of Finance U, where we discuss all the things we can breaking in the markets and what's going on in the world of finance. And we'll use terms and phrases, hopefully, that you can understand, because, listen, enough jargon out there in the world anyway. So I'm back this week, of course, with Paul Kiker of Kiker Wealth Management. Paul, good to see you.
Good to see you as well, Chris.
Yep, I kind of look like a homeless guy, but give me one more week and this will grow out proper.
It looks good. It looks good.
Yeah, it's coming along. It's coming along. It was great to spend time with you last week. Of course, we were out in the backcountry, got to reflect, see some stars under the big sky. It's a much needed break for me to figure out, think things through, look at things. Came back, and the week before last, we talked about how everything is nuts.
Yes.
Paul, everything's nuttier, I think.
Right. They must have upped the medication and the water supply. There's no doubt about that.
Yeah. But, that was kind of a refrain talking with other people in this past week. Every time I do, I keep getting this refrain, which is something like, this isn't adding up. They just get that sense. Something's not quite right in the story. So I want to talk about this, something not quite right in the story, because, we're hearing from Trump. Economy's on fire, never been stronger, usual sort of Trump terms. But this is from Nick Gerli, and noting this is the amount of growth in jobs compared to year over year, right? And you can see here it is slumping pretty hard, and it's now at 0.97%. This is for sure recession territory below this line, because that's negative employment growth, which means people are losing their jobs. But you can see here that every time it's kind of gotten below this mark here, every time it's rolled like this, it's inevitably headed to a recession. Here we are. This looks pretty weak. So that's BLS job growth. Pre-recession warnings, he's saying, looks pretty weak.
Yes. And I'm also hearing consistently, especially in the white collar jobs, that people are having a hard time finding employment. Like there's several people out there, have friends that are panicking right now. They've never had a hard time just jumping from one place to another, but they're 60, 90 days out of looking pretty hard and still haven't found anything yet. So there's serious weakness in the labor market at this point. And it looks like AI is going to magnify it.
Oh, I know that the AI is stealing white collar jobs. NAFTA stole the blue collar jobs. This is what Nick had written that went along with that chart we just saw. It says pretty much every labor market indicator he writes here is rolling over at the same time. So the BLS job growth of 0.97% year over year, similar readings to late 2007, which of course was right before the great financial crisis. The ISM manufacturing, now this was supposed to be, we're bringing jobs home.
Right.
Manufacturing index at 43.4. So for anybody listening, anything below 50 is contraction. This means we're shedding manufacturing jobs, according to the Manufacturing Employment Index. Lowest level in 10 years, excluding the pandemic. The Services Employment Index, 46.4, also contractionary. Third lowest level in 10 years, excluding the pandemic. And the Indeed is a website you can go to if you don't know about this, to post jobs and find a job. Indeed Job Openings Index is 105.2, down 35% from the peak, almost back to pre-pandemic levels. So maybe something for the Fed to pay attention to. So that's quite a bit of weakness right there. Again, in terms of adding things up, Paul, can we just put this on the table? Employment is weak right now. Services, manufacturing, and in total.
Absolutely. All of the data is pointing in that direction, and it looks like it's going to continue to decline a little bit. The question is how severe is the pace? And I can't help but just look at the data and then see the backdrop of the market and just the euphoria that's out there. What was it? I've got the data here somewhere, but several of the brokerage houses are saying this is unprecedented buying from retail over the past 4, 6, and however many weeks since the tariff tantrum that occurred back in April. And so you've got You've got retail that just could absolutely care less. You've got systematics, which is your momentum chasers that can absolutely care less about the data. And the belief is the Fed's going to be able to cut rates and we're off to the races again. That's the belief that the market seems to have embraced completely, that it's truly different this time.
Yeah, but cutting rates doesn't really do anything except create more market euphoria for a while, which is a thing. And, while we were gone, it turned out that the BLS just had an oopsie and had to revise a few of their employment statistics. So for May and June, they had to peel off 258,000. Just for those 2 months, they had overestimated jobs by 250,000 over May and June. That is a giant oopsie. Normally, you don't get a statistical revision of that magnitude until you do the January one, because then they back revise for the whole year. So you'll see a big bar way over here. That's the Jan one. That happens. But yeah, and you will notice, Paul, as well, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 out of 19 were negative over the past 19 months. So they seem to be overestimating jobs pretty consistently here.
Consistently.
And then having to peel them off.
And I guess if the data is true, then President Trump wasn't very happy with that, and he laid off the BLS director, correct?
He did, and he did it in a mean tweet, which I know is going to make some people unhappy. So it was. So this is too. So the blue lines are the non-farm BLS non-farm payrolls. That's the headline number that's released by the government, by the lady who got fired. And then there's the ADP private non-farm payrolls. I remember you and I talking about it, because ADP had this huge miss. Oh, they missed so bad for May and June. Oh, they missed so bad. The BLS was way up here. They were way down there. Yeah. Well, turns out they're right. And remember, like E.J. Antoni, among many others, at the time, said another reminder, ADP is hot garbage. So they got dumped on for that.
They sure
Turns
did.
out they were right.
And the interesting thing is I tend to trust their numbers and be very careful, because they're a payroll provider. They're seeing this in real time data much quicker, obviously, than what the BLS is in their estimates. Of course, I know ADP's estimates as well, but they've got better access to quicker time data just based on the nature of their business.
Yeah. And I would note here, Paul, that it's pretty rare, but they actually have a negative print for the most recent week that they put out. There's
only one other going back to the data on the series there.
Yeah. Yep. And then, Trump fired McEntarfer. Make sure I don't mispronounce that. I've directed my team to fire this Biden political appointee immediately. You had two minds of this. Some people said, oh, that's a political firing. He just didn't like the numbers, so she got canned. But the truth is, they've been doing a terrible job at the BLS. They've been doing when you miss consistently 14 out of 19, something's off.
Right. Well, and with today's access to data and the speed of access to data, all they have to do is update their systems, I would assume, to find it more efficient to get this information in there, which would make it more relevant for market participants across the board. And look, I know there's computers that make trades off of that headline data, but it's the revisions that matter more than anything, because that seems to be where we're getting the more honest, but you're looking 6 months in the rearview mirror at that point.
Yeah. And that probably doesn't account for, I'm going to guess, a whole lot of illegal jobs that were being held by illegal migrants who were being paid under the table, who now got skedoodled out of the country. Those were still jobs being done. That was economic activity happening. So I'm going to bet there's a big chunk of those missing. Probably.
That's a good point. It really is. And let's assume whatever the number is that's been deported or left the workforce at this point, or self-deported. And if that's cash payment under there, that makes the labor market even weaker if we're not replacing that with newer jobs that are out there, especially with that void.
Well, we saw non-native born workers plummet a lot and native born workers take a bunch of jobs. But even with that happening, a lot of labor weakness. So something's not right. We're being told the economy's strong. It's on fire. The tariffs are going to bring manufacturing home. That hasn't quite panned out yet. So we have some recessionary signals. And then, Paul, another big topic of conversation was insurance over this past week. And Wall
Yes.
Street Apes reporting here. Here's this woman, and she's crying, and she says, that she got a letter from Blue Shield Blue Cross. Her monthly payments are going up to $2,627 a month for health insurance. Any Europeans or Canadians listening to this, you won't even understand what you're looking at here. $2,600 a month for health insurance? And so she says here, quote, if I choose health insurance, I lose my house. If I choose my house, I lose my health insurance. Either way, I'm screwed. And look at this. I'm not even mad, she says. I just don't care anymore. I guess there's just no winning. So she's fully demoralized by predatory insurance systems.
That's heartbreaking. And I'm hearing story after story. This was stories that I would hear when I would donate some time to counsel individuals that got in financial trouble. They don't have assets, just trying to help them get out of the debt that they've accumulated from time to time. But I'm hearing these conversations in middle class households now. They're having to make choices. Do we insure our house? Do we insure our health? Or do we feed ourselves at the pace that we're doing before, because those costs are rising dramatically across the board?
Well, they are. And, we had, so a couple times ago, we were sort of speculating, like, why did auto insurance go up so much, or why is home insurance going up so much? And we speculated maybe it's their investment. So I tried looking into it. I didn't get that far, Paul, but I did find this. So little chart of the United States here. The lightest blue is $1,000 to $2,000, and the next darkest blue is $2,000 to $3,000. And it's pretty dark blue is $3,000 to $5,000, and the darkest blue is $5,000 or more to average homeowner insurance policy. Right?
Wow.
So you can see here, so my first question is, well, why are Colorado and Nebraska like two full colors away from their neighboring states of Wyoming and Utah?
That's a good question.
Like, how can insurance costs be that different, from here to here? So,
That's
okay.
Yeah.
Okay. And here's how much they've gone up on a percentage term. Texas, just off the charts. Colorado, 57%, so it maps into the same things we were looking at before. Mm-hmm. California, maybe you could say, okay, fires. So I go to an insurance, journal, website, whatever. And there's the link down there. And so they said, oh, okay, well, here's an explanation. They say, new policy premiums have jumped 45% since 2022, even though the average insured value known as coverage A has climbed just 12%. So 45% policy in a 12% hike. And they say, well, why? And down there they say, well, in some areas, homeowners are now spending half or over half their monthly mortgage payment just for insurance and taxes. You remember in the whole PITI, the pity, right? You have your principal, interest. Those were the biggest parts. Taxes, insurance were these little add-ons that, you had to take into account, but it wasn't half, Paul. How did we get to half?
That's somebody must be greasing the pockets of the insurance regulators to allow this to occur in that manner, quite frankly.
Well, you won't believe what they cite next in the article. You might.
Ooh, I can't wait.
Yeah. Well, it's climate change.
Climate volatility? Okay.
Yep. Key culprit, climate volatility. They say as extreme weather becomes more frequent and intense, insurers are increasingly on the hook for massive losses, passing those costs on to consumers. Formerly safe regions in the Midwest and Southeast are now dealing with more convective storms, hail, tornadoes, damaging winds. Coastal areas, long plagued by hurricanes and flooding, continue to face staggering risk. These weather events have accounted for nearly 70% of insured global losses. Now, I'm still not buying this. So I think I'm going to fall down to this where it says another factor adding to the cost pressures, tariffs on building materials. So it could be that they're just more expensive for replacement cost. And that's an inflationary problem. It's not a climate change problem.
That is
right?
correct. Mm-hmm.
So I had to go and look. You know me, Paul. I had to go look. Really? Climate change? Well, would you believe that according to all the data we have out there, I found this through this Chris Martz person here, and hurricanes have actually decreased in frequency since 1980. Major hurricanes, no significant uptrend since 1980, no trend. There's just no basis for this. Here's the data from NOAA. Major hurricanes in black on the bottom, hurricanes in red on the top, going back to 1990. Dude, that's a flat line.
That is a flat line. So it can't
Yep.
be that. That's either
Can't be
greed.
that.
It's just an excuse, a lie. I guess climate change is the insurance industry's version of Russia, right?
Yep, exactly. They just utter climate change, right? EPA says river flooding, they map it. And so over the past from 1965 to 2015, so this is just a little bit old, but there's some areas they saw some more flooding, a lot of areas they saw a lot less. You add it all up, there's been no significant increase, particularly in where they said, the Southeast has more flooding now. Well, not according to these people. How about heat days? You want to know when the hottest times we ever had was right here. This is the Dust Bowl. See that? Mm-hmm. That was bad. That was pre-climate change. Just happened anyway.
Look at that data.
Yep. So it's not that.
No.
So I think the insurance companies are just making it up at this point. It's predatory. It's not. It's not that. It has to be something else.
It sure seems to be the way. Yeah, and that's one of the things I'm hoping I'll have time soon to try to dig into it, because I know just from being in the industry for quite some time and studying insurance companies that they'll take a lot of their premiums. They buy these big high-rise buildings and property and real estate to get the income that's generated off of them. And the only thing still that makes sense is you look at the 10 cents on the dollar sales of many of these major office buildings across the nation, and those are hundreds of millions of dollars that are lost.
To somebody.
Yeah. So they sure seem to be passing it down, or, maybe the executives at the insurance companies are, wanting to keep up with the Joneses and the AI industry now, and maybe they're just having to increase their salaries. I know I'm being facetious at this point, but it's just frustrating to see this occur with no, and I understand the cost of building has gone up dramatically. If you have replacement cost on a home, it has gone up dramatically.
But that's not climate change.
That's not climate change. That's inflation.
That's the Federal Reserve.
Too much money printing and too much institutional money in the housing space.
Absolutely. All right. Well, when we come back, Paul, I want to talk about housing. Got some startling data there on the mismatch between buyers and sellers. So we'll be right back after this. The markets are a ticking time bomb. Volatility is spiking, trade wars have broken out, and most investors are sleepwalking into disaster. Many portfolio strategies perform poorly during times like these. At Peak Financial Investing, however, we don't gamble with your future. Our registered investment advisory connects you with battle-tested wealth managers who reject outdated models and embrace active management. Strategies proven to navigate chaos, and who aren't afraid to discuss things like the great taking, or maybe the importance of protecting your wealth with gold. Without the right approach and with the wrong advisor, you're risking, everything. Don't wait for the crash to act. Visit peakfinancialinvesting.com right now to schedule a free consultation and discuss your particular situation. Take control of your wealth before the markets take it from you. Again, that's peakfinancialinvesting.com, and I'm Dr. Chris Martenson, urging you to act now. All right, welcome back. We're going to turn to housing now. Paul, I think you looked at the same chart here. Pretty astonishing. This is the largest gap between sellers and buyers. There's a 500,000 person difference. There's many more sellers than buyers. You can see during the great housing inflationary boom here, there were many more buyers than sellers. This is kind of an unusual condition. The last time we had a gap close to this would be way back in 2013-14. But that's tough sign there for people who want to sell homes.
That's tough. And that's one of the reasons why the sales data has been so slow, been low, and home sellers are frozen and they haven't dropped their price. I mean, I'm hearing real estate agents still talking about just advising people, hey, take it off the market for 6 months and wait till next spring. That's the argument that, that's the recommendation they're giving them. But my concern is, especially for those that are under $1 million and they're having to borrow money on these homes, what happens when you start to have a few individuals that throw in the towel? They cut their prices by 20%, which brings appraisals down, and it continues to feed on itself. Will interest rates being lower solve that problem? I don't know. There's good arguments that interest rates being lower as Trump's wanting to get them so severely, is that's going to free up more supply, because now you've got individuals that have been wanting to move that are stuck at a 3% interest rate. That's not stuck. That's a good thing if you're at 3% or below. But if rates come down, now it makes it more affordable for them to sell and relocate somewhere else like they've been wanting to do. So I'm really curious to see if cutting rates is going to be, I mean, we're going to find out, I guess, before too long. It's going to be the savior for the housing market that everyone thinks it's going to be, because it's an affordability problem.
Which is dire at this point in time. And it really doesn't correct easily. Wages have to go up a lot. But as we just mentioned, for white collar wages tend to be higher on average than blue collar wages. And of course, those are the jobs, the white collar jobs, are now under severe assault from AI, right? Not just not new hirings, because we don't need to hire people into these roles, but actual firings, as we've talked about before. Coders, deeply at risk, lawyers, junior lawyers in particular, tax, et cetera, et cetera. A lot of things that were formerly, well, anything that's an information-related job where the information is structured, you're in trouble immediately.
Well, and even designers, the artistic individuals that can help design PowerPoints, doing video. I mean, it's amazing what AI is working its way through. Yep. And as far as the jobs. But Chris, here's another thing. We still have so many pressures that are coming into housing that are lagging indicators right now. One of the greatest discussions that I'm hearing in the North Georgia area, across the Southeast, individuals are getting their new tax assessments. And especially in the North Georgia area, they're not even putting your estimated taxes due on the assessment for the first time. I mean, I've always been able to say, okay, this is X amount of dollars. Most people aren't going to find that out until a little bit later in the year. So you've got tax costs that are continuing to rise as these insurance costs are going up, and labor costs are going up for blue collar labor. So houses are always a drain. I always tell individuals, we never count your primary residence in your retirement plan, because a home is an income taker as a primary residence. It takes from you. You have to put into it to keep it up, maintain it. Now, rental property is a little bit different, but if we start to see all of this supply coming online with all the apartments that are being built and the rentals that are being built right now, at some point we're going to run into a problem with mathematics. And the psychology of the investor out there right now is paying attention to what has happened in the rearview mirror. They're not paying attention to what's happening today. So investors are looking in the rearview mirror going, hey, this is great. They're not even looking out the side mirror and recognizing the changes that are taking place, much less looking out the front window of the cars, where they should be looking as to where we're going, not where we've come from.
And as we talked about, I think last time, there's a number of markets now out there right now where you can rent for half the cost of home ownership, put in air quotes, because we discussed the real estate tax issue, is making that pretty blatantly obvious that you don't actually own your home. You just rent it. So if it's half is half. It's hard to make an argument. Why would I go through the headache of having to own and maintain and all this stuff, a home, when I could rent for half? Right. Somebody once told me, he was a very sophisticated real estate investor, because, I go out and hang out with people like Ken McElroy and all the people who come to his and Tarl Yarber's Limitless Expo and other real estate events I go to. And somebody said, you rent where you live and you own what you rent.
And you own what you rent. Rent where you live and own what you rent. Okay.
Yep. So they said, why wouldn't you just rent your home? Just rent it from somebody. But you own the properties that you rent to other people. They felt that gave them maximum freedom, and maximum financial freedom is sort of the goal of this whole thing. And kind of stuck with me. I thought, that's interesting.
That is very interesting. Well, speaking of my daughter, I think I mentioned this a couple of times. She's been looking hard for homes, and she doesn't want to borrow it's amazing how much you can qualify for on an income level nowadays. Like there's tons of liquidity in there. So, and she does good, but growing up in my household and talking long-term and listening to you and, just seeking wisdom to try to make good financial decisions, we've tried hard, and I've gone look at 6 or 7 houses to potentially put, but every house that we can find that's reasonably affordable needs some upkeep and maintenance and a little bit of remodeling just to dress it up a little bit, which is fine because me and the boys can do it. But at the same time, they've got heating and air units that are 15 years old, roofs that are 20 years old. So we kind of sat down, did the math, and said, look, let's just look at it this way. If you're going to be in this area for 5 years and prices were to drop, can you rent it to cover the mortgage rate? And the prices are still so high, even with 20% down, the rent revenues aren't high enough to cover it. So she came to the conclusion, without me pushing, she's like, you know what, Dad, we're going to punt a year. We're going to rent a place, and we're going to wait this market out a little bit. Because you have these listings that are good, and then all of a sudden they start dropping off. And and I'm actually really proud of her for that, because she's really thinking long term and just rent, right? You don't have to worry about replacing the heat and air unit if it goes out. That's somebody else's problem. And this buys you some time to see if things settle down a little bit, and just keep saving your money so that you can jump on an opportunity when it arises. That
sounds smart. Well, our kids often, those apples don't fall far from the tree. So, just how it goes. I did want to talk about this too, which is this is the worst word for the average person. It sounds almost fun, like a stag party, but it's stagflation, and it's the combination, for those listening, it's inflation plus weak or even negative economic growth. It's the worst of both worlds. You have a stagnant economy at best. Sometimes it's even in recession, and you have inflation. So you get stagnant and inflation, stagflation. So this just came up. The ISM Services. So ISM is it's a survey that's done. A bunch of people answer the survey. They have two big ones. They have a manufacturing and then also a services. So this is the services side. So the ISM Services, and it's the Purchasing Managers Index, the PMI. That was a 50.1, which is still technically just a hair in expansion territory, but it was forecast to be 51.5, so big miss there. And the previous was 50.8. They thought it was going to go up. It went down. So that's nasty. But then check this out, Paul. The prices paid 69.9, forecast of 66.5, previous 67.5. Inflation is going in the wrong direction for services, which is a pretty big component of our economy. So, yes. Ouch, get ready for more inflation. So that's the inflation part, but here's more of that stag part. The services employment, 46.4, forecast to be a little negative, but not that negative. And then new orders also kind of dead flat and stagnant at 50.3 instead of, higher. So just barely above 50. When we look at this is the ISM employment index for services. You can see when it tends to cross down and dips below 50. We had a recession there in obviously 2001. We had another big recession here in the great financial crisis. Again, this dip down here. COVID, who knows what to make of that? It's just gray, unbelievable flash down back up again. It's just that's going to queer the data for a long time. But here we are, and we've been kind of weak for a while, but we're back, pretty far below the 50 level. So that creates stagflation. Engram Macro did a good job sort of summarizing this. Said, last time we saw the services PMI barely holding expansion while prices paid surged near 70 and employment contracted. We were in early 2008. So that right at the same time, if we were looking at the services paid, it would have also been going up. That would have been, it's very comparable to 08. Not saying this is 08, different things, but the stresses are the same in that. And so I'll let people read that, but down on the bottom in yellow, it says, quote, and just like then, trade activity is shrinking. Exports and imports both are contracting, but inventory is still kind of high. Prices are sticky. And this suggests we're not in a healthy expansion or a clean slowdown, but rather in a late cycle squeeze where the Fed risks cutting into a structurally imbalanced environment. And the real danger here is that monetary policy might amplify fragility instead of stabilizing it. I have a chart to show that in just a second, but this is the jaws of stagflation. We see prices paid spiking way up like this and employment down. And so those are the jaws. That's stagflation. So that word's coming out. People are going to hear more and more. And this is just a nice chart of the services paid. See this rise here, Paul? I was kind of surprised. This is 2020. This was our big inflationary spurge that we had back there. this is equivalent to this. We're getting back up there.
We sure
that
are.
kind of surprised me. I didn't know. Yeah,
I didn't either.
Ouch.
And looking at that chart, I was very shocked by the prices paid in that survey. But you know what's interesting, if you go back to 2020, it makes a little bit of sense, especially makes very much sense when you look in hindsight. You shut the economy for a period of time and a just-in-time inventory. You flood people with money, pay them more to stay at home than what they were working. And of course, that's more goods chasing fewer goods, and then you have this inflationary spike. But we don't have that backdrop where we are right now. The question is this just those inflationary seeds that were planted before, and loose monetary policy right now, and this fiscal foolishness that we're continuing at the federal government level, working its way into prices, but yet not changing the employment tide? That's not good for the average individual. That's the worst nightmare for consumers and individuals in this environment. Maybe really good for the top 2%, but it's not good for the other 98.
No, it's just not. And by average person, I mean the bottom 98. PMI prices versus orders. So we're looking at two lines on this chart. White is services PMI report business prices, so white's prices, and blue is new orders. So you can see here, Paul, there was one time here, right around the great financial crisis, where orders kicked down and the prices stayed. There was this big gap. There aren't that many gaps in this data. There's one here back around COVID again, but that's a weird wonkadoodle thing. But this gap right here, the only other time we see it is back compared to that. So what does that mean? Well, prices are going up, orders are coming down. That creates a lot of problems, and that's pressure. So what is the Fed? All people are like, oh, the Fed has to cut rates. They're looking at this data going, if I cut rates and make more inflation in this environment, I might lose control of the inflation. They have to balance that kind of carefully.
Oh, yeah, and crush the dollar in the interim period and turn this into a currency crisis.
Possibly, and which could become a debt crisis. Yeah, right. Tricky balancing act.
It really is. It is. And if you notice in there, though, they always revert back to each other at some point. The question is whether prices paid are going to come down or the other is going to come back up. So something's going to break at some point. The question is, does it break in our favor? We've been very lucky since the Fed started printing since 2008 to be able to kick this can down the road. But it's more and more effort for shorter and shorter periods of time. But what concerns me the most is the average person, Chris, just doesn't know this. Your followers do. And those who are hungry for the truth, they understand this data. And it reminds me of the saying, with much wisdom comes much sorrow, because you don't know when this is going to unfold. And once you see that data, it's very hard to try to navigate that. It's like, hey, do I stay passive and oblivious? Am I active and risk managed in the portfolio? That's what we believe. You need to be active and adaptive, because this period of time throughout the valuations of the market, the euphoria, the full belief that the government, through the Federal Reserve and Trump, somehow is going to be able to pull this off, pull some magic trick out. And then I noticed yesterday the White House put out a video talking about don't be a panicking again. So, we're going to belittle you if you're concerned in any way whatsoever about what's taking place. Just put all your faith in us and we'll be okay.
Yeah, don't put your faith in those humans. How about this? Darth Powell said, hey, remember when they started dropping interest rates in 2007 and it prevented a crash? Lol. The truth is, by the time the Fed actually starts cutting rates, it's actually that's one of your better indicators. It's time to run, not walk away from the markets for a little while. Get your risk managed pants on and make sure they're buckled, because most people, when the Fed starts cutting rates, things will get better. Actually, the data says when the Fed starts cutting rates, that's when you're about to head into the trouble.
Yes. With a backdrop that any market pullback should be panic purchased immediately. I mean, the pullbacks in the market, especially since April, are getting shorter and shorter and shorter with massive retail. I mean, we're in the 100% percentile with Citadel Securities, and their retail customers, buying these dips here in the short run. I mean, it's amazing, the euphoria, and I don't even think they realize they're speculating, Chris. It's just looking in the rearview mirror and assuming that things are going to continue this way forever. And that's where that's the point. We don't know when it's going to end. Nobody does. But that's the point of the greatest amount of risk. That's that classic economic cycle. And I don't have that chart on computer right now, but
well, I got a couple.
Emotions.
Oh, that one. Yeah, no, I've got a couple charts that just show just how extreme this is, just to continue to reinforce that. We've done it every week for a few months. But to finish up the stagflation part, though, this one does break my heart because I know it's just going to it's already hard. That poor lady crying, saying, what do I do? Health insurance or a home, right? It's a terrible choice. But when the data just came out that I just saw where they asked the question and they said, hey, in terms of buying a home, paying for college, finding affordable childcare, raising a family, paying your bills, finding a good paying job, asking them each one of those 6 questions, they would say, is it much harder? Is it somewhat harder? It's about the same. Is it somewhat easier? Is it much easier? And so the total saying it was harder, either much harder or somewhat harder for buying a home, 73%. Pay for college, 72%. Affordable childcare, 69%. Raise a family, 69%. It's just harder. It's much harder. Pay your bills, 65%. Harder. Find a good paying job, 62%. Harder. So for most people, it's just harder to get by. And you can see the 10% down there at the end. Oh, yeah, it's easier now. Those are the people who have sort of, that the Fed is directed its fire printing hose at. Like, we really have, it's a tale of two worlds now, Paul. We got a few people doing really well, and then there's everybody else. And that's no way to run a stable society, unfortunately.
No. No. In no way whatsoever.
I mean, this is just the reality it's just getting harder for everybody.
And that breaks my heart. That's not the way that it should be, Chris. It's not the way that it should be. I mean, we've convinced a whole generation that leverage and debt is the answer to everything, and trickle-down economics, all of this is going to happen. Well, it's one thing if you've got trickle-down economics, if you're keeping your manufacturing at home, but you ship it overseas and got the blue-collar workers, and now those same individuals that ship those jobs overseas are in the AI space, which is coming after the white-collar workers. And it's just continuing to line their pockets at the average individual's expense. And they've surrounded themselves with individuals that are more interested in making money on money than they are actually making a difference in society. And, I mean, I've seen business owners that have built good businesses and solid businesses. They know every one of their employees. They take care of them. It's usually that third generation that comes in that doesn't care about those employees anymore. They care more about making the money, as much money as they possibly can. And that's going to break at some point, and it's going to be catastrophic for those who are not pursuing wisdom in environments like this.
Well, I think a lot of people, if this chart is true, there's a lot more people just sort of hanging on by their fingernails. And I think one way, Paul, that we see that is in, let me turn to this section. Bill Bonner wrote a book titled Empire of Debt. I thought it was beautiful, the title. So I just stole the title here for a second. Empire of Debt. If we're in an empire, it's an empire of debt. Did you see this data? Just pulled it today that New York Fed adds it all up. Total second quarter of 2025 household debt rises 185 billion to 18.39 trillion. So houses took on 185 billion of debt, including all the way at the bottom, auto loans rose another 13 billion to 1.66 trillion. Auto loans, right? Mortgage debt up an obvious 131 billion. I guess a lot of that, 12.94 trillion, but 18.39 trillion from a household debt to GDP. This is big. These are big numbers. Not as big as Canada's, but that's a different story on a GDP basis. But so anyway, massive debt. That's how we're skating by here, Paul. We're having to squeeze into homes we can't quite afford, more mortgage debt, and we're buying cars we can't quite afford. So we got auto debt, and of course there's credit card debt, and student debt. Did you see this?
Oh, I had that chart. I saw that earlier today. What was amazing to me about that chart is look at the color. So 50 plus, look at the delinquencies at 50 plus.
1 in 6.
Yeah. And then you've got your 40 to 49. I mean, that's a lot of pain. If you're 50 plus, you're supposed to be in your highest income earning years.
Yeah.
I know that's not always the case, but that's quite incredible. And that's the one debt that you can't bankrupt from. I mean, you can you can default on it, but you're going to have your wages garnished or your Social Security taken at some point in the future if you don't pay that.
Yep. So this big gap here was the Biden forbearance period. But I think you can see that in almost every case, the trend before is higher than that now. Here's where it was before the forbearance. Now it's higher. This is a lot higher. This one's a lot higher. So the forbearance didn't like help anybody. They didn't like save up for a rainy day to be able to. Nope. They just said, you know, I didn't pay that for a couple of years and I just don't feel like it anymore. So
yeah, the sad part from what I've seen about the average individual over time, you know, you would think that, hey, I've got a forbearance right here. I'm going to save this money. I'm going to build up my emergency fund. I'm going to make myself a lot more resilient to whatever economic cycles come through. But no, I would anticipate that what those individuals have done is they've increased their lifestyle by that difference because they're marketed to in a very powerful manner in every way to try to keep up with the American dream as they see fit. And now they got to make a difference. Do I cut my lifestyle back or do I just default on these?
I didn't even get into credit card debt, but we've talked about it a couple times ago that obviously credit card delinquencies are also up. So it just has a little sort of a YOLO feel here. You know, I get it, right? People are saying, like that woman with her knees hugged up, she's just sort of demoralized. She's given up. There's no winning. It's a rigged game. Well, if the game is rigged, you know, could you see it, Paul? Maybe some people just like, let me get as many credit cards as I can. I'll max them out. Let me just grab this car, you know, today while there's still all this liquidity. I have no intention of paying it back, right? Or whatever the story is. If the only reason you would participate in the system and play by the rules is if you think the rules aren't rigged. You know, I could see people deciding it's rigged, like that lady.
Yeah, and I mean, when you get desperate, why not just borrow yourself into oblivion and live as high a lifestyle as you can in the interim period? The problem is there's going to be major consequences for that in the long term. My concern is I believe that they've pushed this, and debt has not been respected at the government level, specifically at the political level. And then that's trickled down through the rest of the economy that there's going to be some major pain at some point in the future, because all debt is, at the basic level, debt is taking future income potential and pulling it into today's purchasing power. Well, that's one thing if you're investing into a business, utilize that debt. But even if you get irresponsible with that business debt, that business will fail. But there's been a lot of debt that's been taken on to maintain lifestyle. Now, there's a difference between lifestyle and basic cost of living. I think there's a lot of people out there right now that, because wages have not increased with all of this asset price inflation and with the cost of living going up, that people are having to take on debt to feed themselves and make ends meet on a regular basis. And they're just hoping that something will change at some point in the future. And that desperation makes sense when you look at suicide rates and drug addiction rates. And I mean, one of the things that nobody talks about anymore, but especially young couples, one of the biggest reasons for divorce is financial strain. And that weighs on people in a ridiculously heavy manner. And it's heartbreaking. You look at all the statistics across our society, and the American dream is killing people right now.
Well, it really is. Maybe stocks will save us all, Paul. Maybe stocks.
Yeah, they might. If it's completely different this time.
Maybe it is completely different. So, did you see this chart?
No, I've not seen that.
So this is this is looking at the MSCI World sector in style valuations, 12-month forward PEs relative to the last 20 years. And if you're in this if you're anywhere in this bar right here, you're somewhere between the 10th and the 90th percentile. And this little blue box in here would be the 25 to 50. This little orange dot is our current. So we're outside of like the highest you could we're above the 90% band for IT. For growth, right at the top. We're at the 90th percentile. For industrials, way above the 90th percentile. There's a few down here like energy, right within a range. Financials at the top of their little bar. Materials. Point is that this is about as expensive. When you add up all those dots, this is as expensive as it's been in a very long time. So we say, oh, okay, well, how's this all going to resolve? This was crazy to me. Holger Japitz, which is at Schuldensühner, said, ouch, the S&P 493, that's the S&P excluding the Magnificent Seven, so 500 minus 7, 493, is expected to deliver just 2 to 3% net income growth in Q2, 3, and 4, which is slower than inflation, he says here, meaning most of the market's barely growing in real terms. Measured against this, U.S. equities are quite expensive. So can you imagine that? Like, just, you're going to pay top dollar for stuff that's going to turn in, you can get better returns out of treasuries.
Yeah. Well, and that's one of the arguments that Husband makes in his data is from a risk-adjusted return, treasuries have less risk and better return metrics looking forward based on valuations right now than the markets do in general. But look, it takes discipline. It takes a long-term focus. It takes looking where you want to be instead of where you are to make those decisions. And that's not a character trait that's been developed in our country for quite some time.
Well, this is Palantir. So Palantir just hit a 300x forward PE. You know, I've seen this chart before. You have too, because we both lived through the other bubbles. I just don't know what the thought is for people who are buying into that with abandon there at the top. Except, you know, they're going to get out at the right time, I guess.
Yeah, that's a hard thing to do. That's a hard thing to do.
Isn't
wow. The risk reward there it's just not good. But I mean, look, the other side of that's going to look and say, well, if you'd have told me to wait at 70, I wouldn't be owning it where it is right here. But that's great if you owned it. This is a dangerous place to enter it right now.
Well, Sven, looking at this, they had a $60 million revenue beat, and they slapped on $15 billion in market cap expansion in the after hours.
250 times what their earnings beat was.
Yeah.
15 billion is 250 times 60 million. I ran the math on that last night.
Did you?
Yes,
oh my gosh. I mean, I'm just shocked.
I had Grok do it, so if it's wrong, it's Grok. But Grok's really good at math. So
Grok is good at
that. Is 250 times 60 million revenue beat.
Wow. That's frothy, isn't it? Seems a little frothy to me. I don't know.
I mean, at that price, how do you buy it after that? So, I mean, that's 250 times increase in market cap what the $60 million beat was. That's crazy. That's priced in a lot of future growth.
We're in bubble. It's just bubble time. Now, I listened to a really incredible interview with Richard Warner on Tucker Carlson. And Richard Warner's the economist, right? He worked with the Bank of Japan. He's worked at Deutsche Bank, places like that. So he's kind of an insider. I think he must have had a turn at some point because he sort of realized what the game actually was. It's always different than what you think as a young man going in. Seems like he wised up. But all that said, obviously he had some great insights. The whole thing, Paul, is just the whole thing. Everything depends on the banks making loans because that's how money is created in our system. So that's it. The whole thing, all of this crazy stuff, this just depends on the money system just constantly expanding, you know? And I think we could both think of reasons why, like it's supposed to breathe in, breathe out. Can you imagine like a forest that never caught on fire in a forest fire region? Well, eventually it does catch on fire, you know? And not good.
Not good. Well, I mean, we've seen what happens in California when you're not having controlled burns and what takes place there. It's absolutely devastating because you have so much tinder fuel to feed that fire. And we got, you know, when we were on the gold standard, you'd have inflation, then you'd have deflation. You had inflation, then you had deflation. And quality of life for the average individual was great. This whole system is set up to reward those at the top at the expense of the others. Yep. And it keeps us on the treadmill. It just keeps us running on the treadmill. And as long as it continues, it's going to be very hard for people to escape. And it's getting harder and harder and harder and harder because one mistake, one stumbling financially can set you back decades, and it's a lot harder to recover. That's one of the reasons why I believe that risk management is so important in these environments. Typically, it's not the missed opportunity that gets you in trouble, because if you're looking at a long-term cycle, that missed opportunity returns, right? It's the lost capital that gets you in trouble if it's not different this time.
Well, it better be different this time.
Yeah.
Just global markets investors. You see this one? Holy cow.
goodness
U.S.
gracious,
tech
I'm not
stocks.
seeing that.
U.S. tech stocks relative to the S&P 500 reached 2.2x in July, the most ever recorded. Tech. The ratio is now way higher than at the 2000 dot-com bubble peak. Metric also sits well above 2 standard deviations from his historical average. Crazy stuff, right? So it's tech. It's all about tech. Now, I'm old enough to have gone through the 2000 bubble, and I invested in some of that junk, got caught in it, right?
Mm-hmm.
And I remember, there were these things. Remember, Paul, was eyeballs. There was always a reason. It was, miles of fiber optic laid. There was at one point they were laying down fiber optic, because they're going to need it. Same story with AI. Oh, man, we don't know what they're going to use it for, but they're going to need it. We're positive, right? And then that turned out to not be true, right?
Mm-hmm.
I still can't figure out the business case for AI for the general economy. I understand how individuals will use it. Companies will be able to be more lean and efficient because they won't have to hire people. But in general, those are specific cases. In general, the economy is hundreds of millions of people working and buying stuff. What if they're not working? I still don't get it, Pretty smart guy. I still can't quite figure out how this, in general, this all works out. I can't see it yet, but it has the same flavor to me as laying all that dark fiber cable that sat around for a decade before we found a use for it.
It does. And look, those two prior peaks, the one in 1970, I'm assuming that was close to the time that the Nifty 50 peaked.
Mm-hmm.
When did Nifty 50 crack? It was 1972, I believe, but I clearly remember the year 2000. And I thought, back then I was 2 years into the industry, and I always sought out the cynical, older, scarred, wiser guys. And they're just like, we don't even know what world we live in, right? Like, we don't understand this. So that helped me to understand the euphoria that was out there and just the pure speculation, the ignorance of the details. And yeah, I didn't have as much skin in the game back then. But the reality is I experienced it, went through it, invested through it. And now what we're experiencing is well, the chart's showing, but I would say the chart doesn't even reflect the emotional euphoria and the belief that this time is different than the average investor out there right now. I mean, even the ones that understand they need to be in risk managed strategies and understand you're kind of frozen, right? It's like, well, maybe next month I'll make that change. Maybe that next month I'll have that conversation. But the problem is when it turns hard. I don't know if I've shared this idea before, shared this story before, but I'll never forget. Around the year 2000, met a lady. She was a secretary at Lucent. Made around, these numbers are going to be close, guys, because it's been a long time since I've told this story. Somewhere between 35 and 40,000 a year. Her 401k was around 1.5 million, 100% in Lucent. So I met with her and I'm like, look, interest rates back then were 7%. I said, you can retire, diversify, and make more money staying at home than you can at work. So that was kind of her plan. She was going to retire. So she worked for some of the C-suite, and they're like, look, you're crazy to sell it. It's going to double. It's going to go up. Just don't get out. Hang in there a little bit longer. Well, inevitably it turned, and I can't remember the specific numbers, but this is in general how it went. It goes from 1.5 million down to $1 million. And I'm still having a conversation. You're set. You're ready. You can get out from retirement. No, I'm a long-term investor. When it gets back to 1.2 or 1.25, I'll sell. Then it drops to 800. Then it bounces to 900, but she wanted to get to $1 million. Then it drops to 500. And I watched this unfold to where I can't remember what the bottom price on Lucent was, but it went all the way back to under $100,000 if I remember correctly. Yes. And she went from being able to retire to never recovered that somewhere else. I mean, she worked a long time. Her lifestyle completely changed. Now, luckily, she didn't reset her lifestyle in that environment. But that's one thing that I learned from a historical standpoint is you've got to get out when the getting out is good. And so what if you don't hit the top? When you look at historical data that shows that this is a period of time where it's ridiculously dangerous. I mean, I don't live in an area where people go walk on lakes, but I do know that I've heard stories time and time again that we teach our kids when a good freeze comes in North Georgia. It's like, don't go walk out on the ice, right? Even the ice road truckers, they're pushing it at the last minute so that they can get across there. There are certain thresholds that matter from a long-term standpoint. And the reason why we use mathematics is it helps keep our emotions and our biases and our mental weaknesses of giving into that euphoria in check. So, because I'm telling you, I know what's going to happen. This thing's going to turn. I mean, I don't know when. But if it's not completely different this time, even if it is completely different, let's say, Chris, our price to earnings ratios are higher, but they just reset at a higher level. There's still going to be downturns. There's nothing that we can do to stop that from a government level, because if they do try to print too much money, then we're going to end up into a hyperinflationary holocaust. And that's a completely different set of problems. And you're going to have to invest in a completely different way than what's working right now to be able to protect your wealth on the other side of that. We don't get out of this without pain. No matter how much they promise, there will be side effects to the environment that we're in right now. And I believe that it's going to be like the Great Depression, however this unfolds. Now, whether we have a deflationary depression or a hyperinflationary holocaust, I don't know. I'm ready to react either way. But in the future, there's going to be generations that are going to look back and go, how stupid could they possibly be to believe that they're as educated and have as much information they have? Information doesn't give you wisdom. Studying history, paying attention to what stood the test of time can give you wisdom. It doesn't matter how much information you have if you don't have the wisdom to know what to do with it. And I believe that in today's society, information's easy. Information used to be power. Information is noise right now. And we should all be asking God to grant us the wisdom to know what to do with the information so that we can navigate the days ahead and protect our families and our communities and our own wealth that we've sacrificed to set aside.
I think it all begins with education. You have to have the context. And unfortunately, a lot of people, Paul, aren't willing to do that or don't want to, often because they might come up with information that's counter to what they want to think. I'm thinking about the secretary at Lucent, right? You know, probably just didn't really want to hear anything other than I'm going to be rich, it's going to go up, right? Which is hard. I get the mindset, it's hard. But this is for people who can listen, who have ears to hear, I think, and eyes to see, this data to me right now is telling us that we're in crazy unprecedented bubble territory, which is always dangerous, right? Because you have to believe something that's really weird, which is this time is different. Oh no, Chris. Yeah, no, we made some tulip bulb mistakes, railroad mistakes. These are other past bubbles. We made, an internet mistake. But with AI, this time is different. This thing's going to change everything. Like, yeah, maybe. Right. I know it's going to make my electricity costs go up. I know it's going to chew up a lot of water in some areas. I know those things are true. But in terms of how it's going to be used, it's too early to really say. And here's a prediction. It'll do some good things and it'll do some bad things because it's a technology. Mm-hmm. It's a powerful technology. It'll be used for good and for bad.
It sure will. But speaking of AI, so let's say AI is going to solve the problem for everything. What it does is it's competitive. So we're looking at these AI trading models, right? Mm-hmm. So there's a guy that's tracking those. And what we're finding is they're all gravitating towards doing the exact same thing. So what makes a market is people thinking through and doing different things at different times. But what AI is doing is just tracking, hey, what's the most successful thing in this period of time? And what does that do? Even AI at some point, because it's built off of knowledge that we have placed out there. So there's still human weaknesses that are inside of it. If everybody gets stacked on one side of the boat, then the boat flips at some point. And that's creative destruction that opens up for the other side. And I thought that was fascinating because I really thought that AI would be implementing various strategies across the board, but it seems to be driving everybody into the same strategies. Because what are you going to do? You're going to chase what works. That's the ultimate. That's the ultimate bubble maker, is what it is.
There was this Monty Python skit. I must have seen it 40 years ago, where it's just a quick thing. They're doing the Olympics. And they said, and they compete for various silly Monty Python kind of things. And one of my favorite skits was they had 5 of these guys lined up, and the race was for the most average walker. So 5 guys take off, but they're all just looking at each other and just trying to be more average than the next guy, So they're kind of like, is that what AI is doing? The AI is all looking at what the other AI is doing, and they're going to just come up with the most average, approach to trading when they finally get down to it.
That's what the data looks like as far as correlation across the AI trading systems. It's pretty fascinating. It surprised me, actually. Because,
yeah.
I mean, what are you going to do if one AI goes all in Palantir at this point and, they beat on their earnings and it goes up 250 times in market cap, what their earnings were actually were? Well, what are the rest going to do? They're going to be looking for something similar to that too from a momentum backdrop.
Yeah. So don't forget, amongst all the other things, Paul, I'll pull up a little bit from last time. Remember, margin debt is over $1 trillion right now, so that is a little different. It's a lot of margin debt. So margin debt, for anybody listening, is when people borrow against margined securities so that they can go long more of those same securities, typically. So at any rate, you have 100 shares of stock, you can margin it. It would allow you, making some numbers up here, but roughly speaking, to buy 50 more shares or something like that. Could be more, depends on the stock. But at any rate, yeah, so a lot of borrowing there.
Yeah, a lot of borrowing. Well, I'll tell you what was interesting. I can't remember if I told you this before we started or not, but I was talking with some real estate agents here recently, and they were discussing that they were surprised because a couple of individuals had not paid cash for a home at, over the $1.2 million range. And the statement was made, well, why should I sell any stocks to go buy the home when my stocks are doing so great? Like, I'm just going to leverage everything to the hilt so that I don't sell any of these because I'm making so much money and there's nothing that's going to stop this train. And hey, it's been a while since I've heard that type of mentality. I knew that there were individuals that were margining some of their positions to pay cash for some of these homes, but now they're not, because margin debt, I think, is 7.5% right now, which is still a little bit more than what mortgage debt is. So that's spending future money that they assume is going to be guaranteed. And that's a dangerous thing to do with valuations where we are. It really is.
Sure is. So obviously a lot hinges on whether the Fed prints more or cuts rates, which is sort of used to be a version of printing. It isn't today, but that's semi-related concept in investor psychology. But all of this really requires everything to kind of work out pretty perfectly. It
really does. I mean,
but I can't see the Fed cutting rates. How the Fed going to cut rates with stocks at all-time highs, basically, right? At all-time excessive valuations with inflation on the rise. I can't see it. I mean, they might anyway, but then, as you said, they're going to start burning the dollar and potentially burning the bond market up.
Hey, I don't know what the answer is, but that's one thing that I'm, mentally grabbing a bag of popcorn and watching. I'm looking. I don't believe that rates need to be cut like they are. But what I have noticed is a lot of my modern portfolio theory friends in the industry, they're in a near panic for the Fed to cut interest rates right now, because they're actually concerned that there's no way that this can continue, because they're seeing higher interest rates slow down home prices. And then you've got other individuals that are coming out. I mean, even Tom McClellan put out a really good chart the other day that says the Fed's behind the curve right now. Smart people. I'm curious to see what's going to occur when they do cut rates. Is this going to fuel? I do think that you're going to have some pent-up demand, that people are going to have a reflexive activity to where they're going to be like, oh, let's buy stocks and let's buy houses. This is going to solve the problem. But some of these trends that are taking place under the surface are going to continue to pull down, and that's my concern. I don't know what the markets will do. I don't know if they can print enough market money to keep a decline from occurring. But from a historical standpoint, a 50 to 70% decline in the markets. And I know people are going to think that's crazy when I say this. Just mathematics, right? Go back and read some of John Hussman's work. He's done a great job of stating that. Or based on what we talked about a couple of podcasts ago, where his valuation metric is right now, and all of the scatter plot throughout history, the most likely return for the S&P over the next 12 years is negative 12% a year. 12%? I think it was negative. Let's just say 10, because I don't want to overestimate. The likelihood of positive returns over the next 10 years is extremely unlikely unless we get perfection. And there's very few things in this world that comes through to perfection, sustained for a long period of time. We get perfection in the short run. I mean, a hole-in-one happens, I don't know how often, but it doesn't happen in every round of golf. And that's what this market's going to have to do. The market's going to have to become a golfer. It's a hole in one and 18 holes for a sustained tournament. I'm showing my ignorance in golf. I haven't played in a long time. But a hole in one for 18 holes for however many rounds a tournament has from this point forward to continue the momentum that we have going on right now. And that's going to be hard to do. I'm not saying it's impossible. I don't know that it's ever been done before, but we're getting ready to find out whether that's the case or not. And those that are expecting that outcome, I'm concerned they're going to be extremely disappointed, because right now is a period of time to where you can sweep some off the top, build your resiliency, 12, 24 months worth of emergency fund. I mean, so what if you miss a little bit of opportunity if things continue to go? What if they go for another 12 months and then you have a 30, 40% downturn and you lose your job and it takes 24 months for the economy to restructure itself to come out the other end? Well, if you swept some of that off the top, you know what? You're in far better shape than 99% of the other people that are out there. The 1%, maybe they've got enough funds that they'll be set aside and fine. But the biggest difference is maybe you don't have to go into debt. Maybe you don't lose your house. Maybe you don't have that foreclosure. Hey, coming out the other side of a major recession with a protected credit score puts you in a position where you can re-lever if that's the most important thing to do. I really struggle why it's so hard for people, like Buffett says, buy when there's blood in the streets and sell when everybody's greedy. I mean, everybody respects Buffett for the outcome that he's established over his life. And yeah, you could argue that he was investing during the greatest super bubble we've seen in economic history, but it doesn't matter. His principles apply in every market environment. So I would encourage people, build your resiliency right now, sweep some off the top, get yourself in a good position. If not a recommendation, depending upon your circumstances. I can't give a recommendation. I think you give that disclosure in there. But if you don't have any precious metals, I wouldn't necessarily go out and pile into gold right now. It does look a little toppy to me here in the short run, but I would certainly average it into it over the next 6 months and maybe use that as if you've been fortunate enough to ride this wave as long as it's been going on. I can't stress enough that this is a time to be building resiliency and building your foundation to set yourself up so that you have some freedom and flexibility in the future. And if you're close to retirement or in retirement, stress test your portfolio. See if you can endure a 50% decline and not run out of money. Because I'm telling you, I saw it happen to people after the year 2000 to 2003, after 2008. And those aren't the people that are down at the, at the local breakfast place that are bragging, hey man, I got wiped out and I had to sell my house. Those are very quiet stories. People brag about their successes, but they don't brag about their failures. Unless you're like me and you that have been involved in the markets and you deal with a lot of people, you don't hear those stories. I've counseled people and it is life-changing. So there's a time to be ridiculously aggressive. That's when there's blood in the streets. When everybody believes that nothing can possibly go wrong, that's the time to peel back and be a little bit more conservative. Am I saying sell everything right now? No. But is there anything wrong and foolish about sweeping off the top to build your resiliency in case it's not different this time? No, that's just wise, quite frankly. It's just wise.
They say that an old saying I got from a guy who taught me trading, futures trading, way back in the day. He said, your portfolio is like a bar of soap. The more you handle it, the smaller it gets. Right? So
that's good.
So the point was that you really just got to sort of pick your positions and hang for a bit. So I get that. At the same time, you're saying, there's times when you just say, okay, just take some chips off the table, just going to walk for a bit, go to the bathroom, see what's happening when we come back. And that I think if you feel like you need to be busy, doing stuff, this is a great time. And I was counseling my son to do this because he's like, oh, if I want to start being an investor, I said, oh, let me tell you about what Kenny did last year. Last year, he and his team looked at 600 deals and they took one. If they could have taken all 600, they would have. So they were diligent and they're doing their thing because this is their job and they're looking for value for investors. But if it isn't right, it isn't right. But this is a good time to develop buy lists for things, right? So do your work, figure out which sectors you want to be in. There's always value out there somewhere. So remember I showed all the things that are overvalued? One of them, energy, wasn't one of those. right? And I just gave this talk at Limitless saying, hey, I got some data here. I don't know. Comes from the government itself this time. Looks like we might have declining oil production going forward. Seems like that could have some implications, right? And at any rate, there's still value. There's always value out there somewhere. So that's it. You could stay busy,
That's
without handling the bar of soap. Just figure out where you want to be. Take a few chips off the table, and then think about when, where, and how you want to deploy them, because there'll be time to do that again at some point.
Mm-hmm. Yeah. I mean, commodities, energy, emerging markets. I mean, there are the good thing about these distortions. Well said, Chris. They're incredible opportunities. And I got to say, and all the conversations that we had the prior week, and talking, and I know, I was in awe of most of the charts that you showed and the way you delivered that information. And I mean, I was just, there's going to be a lot of people that wish that they were in that talk 2 years from now, because you laid out that information is incredible. Very well done.
Well, and very timely. There's more. I could have pulled the data up today, but the head of Diamondback, which trades under the symbol FANG, FANG, he just came out and said, that's it. It's in a consolidation phase. He's making a pitch that maybe FANG, Diamondback, would be one of the better consolidators out there because they're experienced, they know what they're doing. But really just making a pitch for saying we're going to have to pull this all together somehow. So I've done a lot of analysis since then, Paul. Can't wait to share it with everybody. But there's going to be some fantastic wipeouts in that space as well. There's so much debt over there. It's got to get paid back someday.
I can't wait to hear that analysis.
Yeah.
And I don't want to change the subject, but I do want to go back and brag on Kenny McElroy, because I've just respected him for the things that he's done over time. He's one of the kindest people. He's always smiling, friendly to everybody.
Yeah.
But I don't know if you were in on the panel. So they were asking Kenny, there was 4 major investors up there. And the moderator asked the question, said, so what have you changed in your formulas to adapt to the new market? Right. Like, and Kenny's just like, nothing. Right. I mean, that's not exactly how he said it, but that's how I took it. He was like, we've got a formula. If it fits in that box, cash flow, we buy it. If it doesn't, we don't. And I just thought that was so wise, because he knows what works and he feels comfortable in that space. And that's one of the reasons why he's been so successful over time and navigated these economic cycles. And I do believe, I don't know how the future unfolds, but let's say even real estate goes through a pretty nasty cycle, because we are in the everything bubble. Mm-hmm. I would anticipate that because he stuck to his rule set and didn't, like my grandfather told me, he said, your integrity is a box around you that has handles on it. If you ever pick up those handles, then you're walking around with no integrity, but yet you feel like you have integrity because you've got this perceived box that is around you. I was just so impressed by that, because that's a Warren Buffett statement in the real estate space, quite frankly.
Yep. Well, I really enjoyed the event as well. I sure hope I get invited back next year. I would go again. It's always a good time. Especially when we get to hang out. And so if anybody's watching, you want to go to Limitless next year, Paul and I will probably be there. Along with some of our kids and all that. It's a really good event. All right, Paul, we've used up our time for today. So thanks everybody for listening. And if you want to talk with Paul and his amazing team, please go to peakfinancialinvesting.com and fill out a simple form. And within 48 business hours, somebody from Paul's team will get a hold of you, schedule things, and you can start developing a plan where you would trade the plan, not the emotions, and start to manage risk. So with that, Paul, thanks for your time today.
Always an honor. Look forward to seeing you again, Chris.